What's the after-tax yield on your brokerage account right now? 200,000 to 400,000 a year, quietly walking out the door. They can be patches on a structural problem. They don't change the underlying architecture of where your money lives. What's the after-tax yield on your brokerage account right now? I'm not talking about the gross return. I'm talking about the net number after federal, state, and the NIIT tax. Fair question. Most high net worth investors I talk to are running 7, 8, maybe 9% gross on their taxable portfolios, and they're calling that a win. But when you strip out the 23.8% on long-term gains, add your state tax and factor in the net investment income tax, it kicks in at $200,000. You're often looking at real after-tax yields closer to, say, 5 or maybe 4%. So on a 10 million portfolio, that gap isn't a rounding error. It's 200,000 to 400,000 a year, quietly walking out the door. So here's what makes it worse. That erosion can compound in reverse. That money you lose to taxes this year doesn't just disappear, it stops growing. So over 20 years, the drag on a 10 million taxable account isn't $1 million. It's often 3 or 4 times that when we actually run calculations and do the math, depending on your bracket and state. So this is legacy capital. This is a family office that your heirs never got to build. So the conventional advice is to harvest losses, hold longer, maybe use a DAF, which is a charitable vehicle if you're charitably inclined. And these can be very fine strategies, but they can be patches on a structural problem. They don't change the underlying architecture of where your money lives. So I'm going to be direct about what I'm going to show you. The strategy involves properly designed whole life insurance, a 7702 contract. And yes, there's costs to life insurance, but they're going to be dramatically reduced with this strategy. I'll put those on screen. You can see exactly what you're paying and look at the math yourself. But what I work with is tax advantage accumulation and a structure that changes the compounding environment of your wealth entirely. So not the investment returns. So people get hung up on returns, the environment around them using volume. The money grows without annual tax drag, moves without triggering a gain, and transfers without going through the estate tax calculation, which is fantastic. And this is not a product pitch. It's an infrastructure decision. If you want to see whether this actually pencils out for your situation, you can book a 15-minute estate fitness call with me. I'll analyze your estate and screen share an illustration. You can look at the exposure and see exactly how your numbers can work, costs included, just understanding your estate exposure, no sales. I hope to talk to you soon. Most middle high net worth families are moving wealth the expensive way, and they don't even know it. This is not a planning outcome. This is a liquidity crisis disguised as an inheritance. So the ultra wealthy don't accept this trade-off. They engineer around it.